What's up, everyone? It's your boy Capitix here. Welcome back to the channel where we break down personal finance and make investing less intimidating. Now, let's be real for a second. You're young, you're ambitious, and you're probably thinking about a million things other than retirement, right? But guess what? The earlier you start investing, the more incredible your financial future can be. We're talking about setting yourself up for success, early retirement, maybe even on a beach somewhere, and achieving that financial freedom we all dream about. Over the years, I've received countless messages and comments from young adults asking for guidance on how to start investing. They often feel overwhelmed and unsure where to begin. That's why in this video, we're diving deep into smart investing tips specifically designed for young adults. So whether you're fresh out of college or just starting your career, stick around, because this video is your roadmap to building wealth and crushing your financial goals. Let's talk about the power of time. And no, I'm not talking about some time travel magic trick. Time, in the context of investing, is one of the most powerful tools you have at your disposal. When it comes to investing, the earlier you start, the more time your money has to grow. This is because of the concept known as compound interest, which Albert Einstein reportedly called the eighth wonder of the world. Think of it like this. You have two friends. Both want to retire with $1 million. They both have the same goal, but they start at different times. One starts investing $5,000 a year at age 25, diligently putting away money each year without fail. The other starts with $10,000 a year at age 35, thinking that by investing more money later, they can catch up. You'd think the one investing double the amount would win, right? Not necessarily. The friend who started earlier has a significant advantage, because the friend who started at 25, even with smaller contributions, could end up with significantly more thanks to the magic of compound growth. This is the power of time in action. Compounding is like this snowball effect. Imagine a small snowball rolling down a hill, picking up more snow and getting bigger and bigger. Your money makes money, and then that money makes more money, and so on. It's a continuous cycle of growth. It's like a free money-making machine working for you 24/7. The earlier you start, the longer this machine has to work for you. The earlier you start, the bigger that snowball gets, and the more you benefit from this exponential growth. It's a simple yet powerful concept. So, even if you can only invest a small amount right now, don't underestimate the power of starting early. Every little bit counts, and over time, those small investments can grow into something substantial. Remember, time is your best friend when it comes to investing. The sooner you start, the more you can take advantage of the incredible power of compound interest. So start today and let time work its magic for you. Look, I get it. We live in a world of instant gratification. Want that new phone? Loan. Dream car? Loan. Avocado toast every day? Okay, maybe not a loan for that, but you get the point. Debt can feel like this inescapable black hole sucking away your hard-earned cash before you even see it. Before you even think about investing, you need to tackle those high-interest debts. Credit card debt, especially, can be a huge roadblock to building wealth. Those interest rates are no joke. Make a plan to pay down those debts aggressively. Consider strategies like the debt snowball method, where you focus on paying off the smallest debts first to gain momentum, or the debt avalanche method, where you prioritize debts with the highest interest rates. Remember, becoming debt-free frees up more of your money to invest and grow your wealth. I know, insurance might not sound as exciting as picking stocks or investing in the next big thing. But trust me on this, insurance is crucial, especially when you're just starting out. Think of it as your financial safety net. Life throws curveballs, and you want to be prepared. Health insurance is a must. We all know medical bills can be insanely expensive. One unexpected accident or illness can wipe out your savings in a heartbeat. Next, consider life insurance, especially if you have dependents who rely on your income. It provides financial protection for your loved ones in case the unthinkable happens. Look, I'm not trying to be morbid here, but being prepared for the unexpected is part of being financially responsible. Having the right insurance coverage gives you peace of mind and protects your financial future. All right, enough with the prep talk. Let's get to the good stuff investing. The most common question I get is, when is the right time to start investing? My answer, today. The moment you have an emergency fund in place and a handle on your debt, it's time to start investing. I recommend aiming to invest at least 20% of your monthly income. But Graham, you might say, I'm barely making ends meet. How can I possibly invest 20%? I hear you. It might seem impossible at first, but start small and gradually increase your contributions over time. Even if it's just $50 or $100 a month, the key is to start building that habit. Remember, consistency is key when it comes to investing. Chapter 5. Investment Options. Building your portfolio. Now let's talk about where to put your money. There are tons of investment options out there and it can feel overwhelming. Don't worry, I've got you covered. For beginners, I always recommend starting with low-cost index funds or ETFs. These funds allow you to invest in a diversified basket of stocks or bonds, which reduces your risk. As you become more comfortable with investing, you can explore other options like individual stocks, real estate, or even cryptocurrencies. But remember, higher potential returns often come with higher risks. It's all about finding the right balance for your risk tolerance and financial goals. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes to minimize risk and maximize returns. Chapter 6. Compounding, the eighth wonder of the world. I know I mentioned compounding earlier, but it's so important that it deserves its own chapter. Compounding is not just a financial concept, it's a powerful tool that can transform your financial future. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. He understood the profound impact it could have on wealth accumulation. Compounding is the process of earning interest on your interest, and it's the key to building wealth over time. It's like planting a tree. The earlier you plant it, the more it grows. The earlier you start, the more time your money has to compound. This is why financial advisors always stress the importance of starting early. Let me give you an example. Imagine you invest $1,000 today at a 7% annual return. After 1 year, you'll have $1,070. Not bad, right? But that's just the beginning. In year 2, you're not just earning interest on your original $1,000, but also on the $70 you earned in interest the previous year. This is where the magic starts to happen. But here's where it gets interesting. This snowball effect continues year after year, and over time your returns become exponential. In year 2, you're not just earning interest on your original $1,000, but also on the $70 you earned in interest the previous year. This compounding effect accelerates your wealth growth. This snowball effect continues year after year, and over time, your returns become exponential. It's like a snowball rolling down a hill, gathering more snow and growing larger as it goes. It's like magic. But instead of pulling a rabbit out of a hat, you're pulling wealth out of thin air. The power of compounding is truly remarkable, and it's something everyone should take advantage of. Chapter 7. Key takeaways, your roadmap to financial success. All right, we've covered a lot of ground today, so let's recap the key takeaways. Number 1, start early. The earlier you start, the more time your money has to grow. This is especially important when it comes to long-term goals like retirement. Time is your best friend when it comes to investing. The magic of compounding means that your investments can grow exponentially over time. The sooner you begin, the more you benefit from the power of compounding. Even small amounts can grow significantly if given enough time. Number 2, ditch the debt. High-interest debt, like credit card debt, can quickly spiral out of control and become a major financial burden. High-interest debt is a huge roadblock to building wealth. It eats away at your income and limits your ability to save and invest. Prioritize paying down those debts aggressively. Number 3, get insured. Insurance is a crucial part of a solid financial plan. Protect yourself and your loved ones with health and life insurance. These policies can provide a financial safety net in case of unexpected events. It's better to be safe than sorry. Having adequate insurance coverage can prevent financial ruin in the face of medical emergencies or loss of income. Number 4, invest at least 20% of your income. This might seem like a lot, but it's a key step towards building substantial wealth over time. Make it a habit to invest consistently, even if it's just a small amount to start. Over time, these small investments can add up to a significant sum. Number 5, diversify your investments. Spreading your money across different types of investments can help reduce risk. Don't put all your eggs in one basket. Diversification can protect your portfolio from market volatility. Spread your investments across different asset classes to minimize risk. This includes stocks, bonds, real estate, and other investment vehicles. And finally, remember that investing is a marathon, not a sprint. Patience and consistency are key to long-term financial success. There will be ups and downs in the market, but by staying consistent and disciplined, you'll be well on your way to achieving your financial goals. Stay the course and don't let short-term volatility derail your long-term plans. Your million-dollar journey starts now. So, you've got the knowledge, you've got the tools, now it's time to take action. Here's a little challenge for you. If you want to have $1 million by the time you're 65, how much do you think you need to invest monthly starting today? Drop your answers in the comments below and let's do the math together. If you found this video helpful, don't forget to smash that like button, subscribe to Capitix for more awesome content, and share this video with your friends who need a little financial inspiration. Thanks for watching, and I'll catch you in the next one.